Hey folks, welcome back to the channel, and we have to talk about the unemployment rate, which increased to 6.1% across Canada, which is already above the pre-pandemic numbers, and it's most likely going to continue higher, which leads me to believe that we're going to hit a recession later this year. What's even more concerning than the unemployment rate is the long-term unemployment number, which I haven't heard anyone else talk about yet. And this graph shows the number of unemployed people for longer than 26 weeks. And I think this is a better indication of where the economy is going than just the conventional unemployment rate. Because if you lose your job and the economy is decent, then you can expect to find work again, maybe in a couple of weeks, maybe a month, maybe 2 months maximum. And if you have like an emergency account where you have 3 months of living expenses saved up, then financially you're still okay. You might have to cut back on discretionary spending a little bit, but since you're not out of the workforce for too long, you can continue to earn an income, so keep up with your rent or your mortgage payments, your other obligations, and things are okay. But the problem comes when you can't find work for 6 months or longer. So when it's been half a year, then you have to make some dramatic changes to your lifestyle, because employment insurance just isn't going to cut it for most people. So you might have to spend not just your savings, because that's probably all gone, but you'll need to sell some investments, maybe live off your retirement savings a little bit. You might have to downsize. You might have to sell your vehicle because you're not using it for work anyway. And that's when you really cut back on your spending, which affects the economy, which is why the long-term unemployment rate is really important to look at. And as you can see, just over the last year or so, the number went from 155,000 all the way up to 243,000. That's more than a 50% increase, which is huge in a relatively short 12-month period. And if we dive into the biggest province, Ontario, if you've been unemployed for 5 or 6 months and you stop looking, then you will not be included in this statistic. It's only for people who are still continuing to look for work, who haven't given up yet, even after 6 months. And as you can see, the number of long-term unemployed in Ontario went from 34,000 in the summer of last year to as high as 81,000 in February, before coming down a little bit last month to 75,000. But that's still an increase of more than double. And at least historically speaking, when we see this kind of increase in the long-term unemployment, it has always led to recession. According to the CD Howe Institute, we've had 4 recessions since 1980, and these gray arrows point to where those recessions occurred. We had one a few years ago in 2020. The one before that coincided with the great financial crisis in 2008, 2009. Then there was a 1990 recession and a 1981 recession before that. So this spike in long-term unemployment has predicted 4 out of 4 recessions in the past, and we're just seeing that again right now. So I think Canada is on the brink of recession. We're probably going to see it later this year. My estimate is in early fall, we will officially be in recession, and then the Bank of Canada will start to cut interest rates. Now, if the BOC is smart, they might look at this data and preemptively start to drop interest rates so the unemployment rate doesn't go up too high. Because when the rate is going down, it goes down slowly, but when it goes up, it usually shoots up pretty fast. But a recession in the US doesn't look as imminent. It appears to be still on its way for sure, but I think Canada's going to fall into recession first. So here's the unemployment rate for the US, and as of the most recent data, it's still pretty low at 3.8% compared to 6.1% in Canada, but it's starting to slowly curl upwards, as you can see here in the bottom right. And it's basically making higher highs and higher lows. So if you think of this kind of like a stock, a channel that makes higher highs and higher lows will likely continue to do that and overall head upwards. Most of the time, it's on a downward trajectory, like from the summer of 2020 to the summer of 2022. Here you can see another long period of a slow downward trend. But the only 2 times where it goes up is right before a recession or right after a recession. So right now, we did not have a recession like recently, the last one being 4 years ago. So most likely this is going to lead up to a recession pretty soon. Going back to 2010, you can see the unemployment rate was going up, but that was right after a recession, so that makes sense. The time before that the rate went up was right before recession. And then here we have it going up again, but that's right after a recession. And similarly in Canada, the only instances where the rate goes up is either right before a recession or right after one. It's clear that the rate is trending higher now. And maybe some people will say immigration will help deter a recession in Canada. And I think that's been true so far because if you look at our annual GDP growth rate, last year in 2023, the economy grew by 1.8% in the first quarter, 1% in the second quarter, and this is annualized. So during that year, it grew by about 1%, which is not a recession because it's not negative. However, 1% is not a lot. And according to the BBC, our population grew by 1.2 million people in that year, 2023, which is a 3% increase to our 40 million population size. So if you think about it, if you increase the number of people by 3%, but the economy only grows by 1%, technically you don't have a recession as a country, but you have a recession on a per capita basis, which means your typical person's GDP or their economic output is down 2%. So immigration is the reason why Canada hasn't fallen into a recession yet. But going forward, the government has said that they will reduce the number of people coming into the country. They want to reduce the number of temporary residents that we have in the country by 20% in the next 3 years. And besides, even if we do get another 1 million plus people into the country this year, those new people coming in, it's going to be really hard for them to find jobs. Because last year at this time, the unemployment rate was 5%, and now it's 6.1%. Plus, those newcomers will be competing with people who already live here, who have been looking for jobs for the past 27 weeks or longer. And all of this is exacerbated by the fact that Canadians now have the highest debt service ratio since recent history. So this is from Statistics Canada, and it's basically showing how much of your income every month goes to servicing the current debt that you have. And for the history of this chart, it has never been this high at 15.2%. And to make things even worse, this number is likely to go up if people are making less money, right? Because if your income is lower, but you still have to pay your mortgage or car payments or student loans, like your debt payments stay the same, then the percentage of your income that goes to debt payments have to increase. So as more Canadians lose their jobs and the unemployment rate goes higher, which will most likely be the case, then it's going to be even harder for Canadians to service their debt. And the reason I think it's very likely that the unemployment rate is going to go higher is this next piece of data over here from an RBC report where it shows the number of Canadian companies going bankrupt on a 6-month rolling average. And you can see from 2022, but especially around this time last year, around March, April 2023, the bankruptcies have just gone parabolic. And it's broken up into different sectors of the economy. That's why there are these different lines. And a couple of years ago, we were still hearing in the news that the service sector was really strong. Like restaurants couldn't find enough waiters because everybody, after the pandemic was going out to eat again. But that's not the case anymore. If we look at accommodation and food services, the index has gone from 128 this time last year to 168. So that's a pretty big increase. And to give it some context, in 2019, the index was at 100. So basically, more companies in the accommodation and food services industry went bankrupt over the last year than the entire 4 years before that, from 2019 to 2023. And of course, it's not just restaurants, it's all the industries, including construction, retail trade, manufacturing. And that makes a lot of sense because for construction, you have a lot fewer projects that get started when interest rates are higher because it doesn't make as much sense for developers to finance new projects. So interest rates started rising a couple of years ago, and the economy, as you can see by this graph, is really feeling it now. And if the central bank wants to prevent the number of bankruptcies from going into crisis level, I think they should preemptively cut interest rates ASAP. Now, in reality, they're probably going to wait until it's a little bit too late before loosening monetary policy. And we all know what happens when bankruptcies skyrocket. You get mass layoffs. Because if a company ceases to exist, then so do all the jobs that it once had. But overall, I think the economy is getting worse in both countries, but especially in Canada. Immigration going forward isn't going to help us as much as it did in the last few years. And the new budget that the Liberals released, which I'll get into detail in another video, but I think that's also going to hurt our economy and will be another reason driving Canada into a recession sooner rather than later. But for now, based on what I've looked at, I think it's prudent for everybody to at least prepare for a likely recession that is coming later this year and do not have a lot of high expectations for the economy. Maybe the financial markets have also sniffed out some of these problems in the economy that I've mentioned. Earnings this season have so far underperformed expectations. And in my last video from earlier this week, I mentioned the SPY index fund is likely going to continue going down and touch the 21 weekly moving average, which is this blue line around 494. And it looks like it did that on Friday before having a little bit of a bounce. So this is the weekly chart. If I go to the daily chart, you can see it's looking very bearish. Now, since we are at this support level and the relative strength index, this one here, is quite extended on the 4-hour, I would expect the bears to chill out a little bit here and for the price to consolidate or move up a little bit because there's pretty strong support right around here. However, if the market continues to go down past this purple line, then I would expect the next level of support to be around here, about 483. Because looking in the past, that was a previous support level where it came down and tested this multiple times. So we'll have to see, but right now I would be very careful about putting any new money into the market, even if there's a bit of a bounce, because unlike the previous times, like these small corrections where the buyers bought the dip, it doesn't look like anybody's here to buy the dip this time. So I would be very cautious about entering new long positions. If you're a buy and hold investor, of course, don't sell your long-term investments because over the next 5 to 10 years, the market is still likely to be higher from where it is now. But for any short-term trading that you might do, just be aware that the market, especially on the daily and the weekly charts, have entered into bearish momentum. So we'll continue to watch the market and new economic data as they're released. But for now, just keep an eye on things and be cautious of the markets overall. Anyway, good luck with all your investments. Thanks a lot for watching, and until next time.